Hi, this is Sabarish from SABARI Securities. Welcome to Option Unlocking Series 2, Chapter 2. In this episode, we will discuss in detail about debit spread. Debit spread is a directional spread which can be used when the view is bullish or bearish. As we saw in the previous episode, debit spread provides hedged and risk-defined model. So we have two different types of debit spread. One is a call debit spread and a put debit spread. So the rules for a call debit is you buy at the money call option, then you sell out of the money call option. Both the buy and sell will have same quantity and same expiry. Right? So likewise for the put debit spread, the rules are you buy at the money put option, you sell out of the money put option. So both the options will have same quantity and same expiry. Now, what is the distance between the buy option and pull option to be considered is basically between 200 or 300 points, or it could be 100 points as per your risk reward ratio, which we will see in a live example. Now let's understand how a call debit spread works. So we know this spread is used when the view is bullish. Now let's take an example. The Nifty closing price as on today is 21,929. Now as per our rules, we buy at the money call option. So the nearest strike is 21,900. It should be our at the money. Plus symbol is a buy. 1 is the quantity size, right? So we buy one lot of 21,900 call option for a premium of 374.05. The second rule is we sell out of the money call option, same quantity, same expiry. So here minus is sell, lot size is 1, and out of the money option is 22,100 and the premium is 267. So both same expiry. So the first option is buy at the money call option, which is 21,900 for a premium of 374.05. The second option is we sell out of the money call option, which is 22,100 call option for a premium of 267. Both the option has got same quantity, which is one lot, and same expiry, which is Feb 29. Now, if you look at the premiums, we paid, buy is premium paid, right? So we paid 374 rupees as a premium and we collected 267 rupees as a premium when we sold an option. So the net premium what we paid is 107.05. That is a net premium. So it is again the net premium. What the net premium is the premium paid, which is the debit, right? So that is why it is called a call debit spread. Now on the day of expiry, we can have only two scenarios emerging. Either the view should go right or the view should go wrong, right? Let's take the first case where the view has gone right and Nifty had turned bullish, and on the day of expiry it has closed at 22,500. So from 21,900 it has closed at 22,500, which has turned bullish. Now what will happen to 21,900 and 22,100 call option? Both these options will become in the money, right? Now, so both the premiums would have increased since they have moved into in the money. So this scenario would give us the maximum profit because the view has gone right. And the formula to calculate the maximum profit is distance between the strike price minus the net premium. So in our example, the distance between the strike is 200 points because the difference between 22,100 and 21,900, right? Minus the net premium is 107.05. So the maximum profit is 92.95 per lot. So 92.95 into 50, because we have considered one lot, which is 4667.50 per lot. Now we know how to calculate the break even, the formula which we have already discussed as part of series 1. So for call option, the formula to calculate the break even is the strike price plus the net premium, right? In our case, we have two strikes. The strike which we need to consider is the first strike. Here is the 21,900 call option plus 107.05, which is 22,008, which means the break even is 22,008 to 0. So if Nifty closes above 22,008 on the day of expiry, this position will give us the maximum profit. In our example, it has closed at 22,500, which is above 22,008. Let's discuss the scenario 2, where the view goes wrong, right? So instead of Nifty turning bullish, it has turned bearish and it has closed at 21,500, right? So in this case, what will happen to 21,900 call option and 22,100 call option? Both will become out of the money, right? So the premium of both these options will go to 0. Buy leg will give us the maximum loss. The sell leg will give us the maximum profit. In this scenario, the net premium will be the maximum loss, which is 107.05. So since it is one lot, it is 5,352.50 per lot will be the maximum loss, right? So this is how the calculation behind the call debit spread works.
So now let's see option payoff chart for a call debit spread as per our worksheet. So here Nifty, look at the spot price is 21,938, which is the closing price, and India VIX is at 15.14, which is the IV, which is India VIX. So as per our example, the call debit spread is, we are choosing expiry as 29th Feb. So 21,900 call option, buy one lot, add position. And then the second rule is we are selling out of the money call option, right? So 22,100 call option, instead of buy, here sell, quantity is 1, add position. Okay. If you look at the calculation here, the estimated margin, which is the capital, is 21,939, right? So if you sell one lot of Nifty, we saw the approximate capital is around 1 lakh. Since we have hedged with a buy, the overall cost of capital is reduced, right? So in this example, it is just 21,939. Now point number 2, let's say if the view goes right, the maximum profit is 4,648, right? So we understood how to calculate the maximum profit from the worksheet. Let's say if the view goes wrong, the maximum loss is 5,352 per lot, right? So what is the risk reward ratio? 1:0.87, right? So the risk reward ratio is calculated between the maximum profit and maximum loss. Now this is why we say a debit spread provides both hedging plus risk defined model, where you have a defined profit or a defined loss. That's called risk defined model. So break even, as per the calculation, this 22,008 to 0, right? So if in case the view goes right, for the estimated capital of 21,000, you make 21% on your capital, which is 4,648. And if in case the view goes wrong, you make a loss of 24% on your capital, which is 5,352. Right. Now if you look at the payoff chart on the right side, if on the day of expiry, if Nifty closes anywhere above 22,008, it gives us the maximum profit. If Nifty closes anywhere below 22,008, it gives us the maximum loss. So this is how an call debit spread works.
Now, let's see how a put debit spread works with a live example. So put debit spread can be used when the view is bearish. Let's say the Nifty closing price is 21,929. So as per the rules, we buy one lot of 21,900 put option, which is at the money, for a premium of 275, and for expiry Feb 29. And then we sell one lot of 21,700 put option, which is out of the money, for a premium of 206, the same expiry Feb 29, right? Here it is a put debit spread, so the premium paid is higher than the premium received, so the net premium is the difference between the premium paid and received, which is 69, which is the net premium paid. That is why it is called a debit spread. On the day of expiry, we know we can have only two scenarios. Either the view should go right or the view should go wrong. In this case, it is a put debit spread, which has been used for a bearish view. Let's say if the view has gone right and the market from 21,929 has gone down and closed at 21,500, right? Now what will happen to these two strikes? 21,900 put option and 21,700 put option will become in the money, correct? So the premiums must have increased for both buy and sell leg, and which must give us the maximum profit. See, the formula to calculate the maximum profit is the difference between the strike minus the net premium. So here the difference is 200 points and the net premium paid is 69. So the difference is 131. So 131 into 50, which gives us 6,650 per lot, is our maximum profit. Now for calculating the break-even point, so we know the formula already, which is the strike price minus the net premium. For call option, it is always strike plus the net premium. For put option, it is always strike price minus the net premium. So in our case, the first strike is 21,900, which is our at the money, minus 69, and the break even is 21,831, which means 0 to 21,831. If Nifty closes below 21,831 till 0, then this spread will give us the maximum profit of 6,550 per lot. Okay, now for the same put debit spread on the day of expiry, scenario 2 where the view has gone wrong, right? So instead of turning bearish, the Nifty turned bullish and it closed at 22,000. Now what will happen to both these options, 21,900 and 21,700 put option, will be out of the money, right? Since both the strikes closed at out of the money, both the premiums will go to 0. So 275 will also become 0, 206 also will become 0. The difference of 69 will be the maximum loss, right? So since it's one lot of Nifty, the maximum loss is 3,450 per lot, right? So the break even is going to be the same. So if Nifty closes above 21,831, the spread will give us the maximum loss of 3,450 per lot.
Now let's see the option payoff chart for a put debit spread. So the rules, options, 29 February. So 21,900 put option. You buy one lot acquisition, and then you consider 200 points as a distance. So 21,700 put option. You sell one lot, just out of the money, right? Now, as per the worksheet, we know the maximum profit is 6,550 per lot. The max loss is 3,450. And the estimated capital is 21,939. So the break even is 0 to 21,831. So if the view goes right, where if Nifty closes below 21,831, the maximum profit is 6,550 per lot. And if the view goes wrong, if Nifty closes above 21,831, then the maximum loss is 3,450 per lot, right? So on the capital, if the view goes right, you make a maximum of 29% as a profit. And if view goes wrong, you make a loss of 15%. So the risk reward ratio is much better here, which is 1:1.9.
Hope you understood the concept of debit spread in detail, and please note all the calculations that we saw in the worksheet is for understanding, whereas all these calculations are being done by the Obstra software, so we don't have to do it for every spread. Thank you for watching and keep looking forward to the next episode, which is credit spread.